Hello, everyone, and welcome to our August market update presentation. I hope you're enjoying the last little bit of summer as we head into fall. I'm Valerie Leonard, founder of EverThrive Financial Group. And speaking of fall, today we have a preview of what we might expect from the markets, inflation, the recession, and more. Now, I had someone ask me the other day how they could access my latest videos, and I wanted to quickly remind you to click the subscribe button on our EverThrive Financial Group YouTube channel so that you're always the first to hear our updates. We are committed to keeping our clients and the community informed on important financial matters, and this is one way that we make sure to provide you with the latest insights. Let's start by taking a look at how markets have performed recently. All major indices have continued to rebound, but as you will see here in this chart, all the volatility in the first half of the year has caused indices to still be negative, as indicated by the column in yellow. So you'll notice the S&P 500 is still down over 11%. The Dow is down over 7%. Mid-cap 400 index is down 9%, and the small-cap 600 index is also down about 9.5%. But if you look at the 3-year performance, you can see that there's significant across the board gains. And it's just another reminder that having a long-term strategy is more important than worrying about monthly market fluctuations. As of the end of July, officially the United States economy has experienced 2 consecutive quarters. We measure this by looking at GDP, which we'll talk about here in just a minute. But this is a standard definition of a recession when you see 2 quarters of negative GDP growth. The issue is that recessions are historically more complicated than just looking at this one data point. Typically, recessions are associated with rising unemployment, with job shortages, and the opposite is true right now. Unemployment actually remains at 3.6%, and there were 528,000 jobs added in the economy in July, according to the Bureau of Labor Statistics. So while we're seeing the jobs market remain strong, we're also watching productivity because it's decreased substantially within the jobs market. And so this is something that we are also watching closely. One other note here on the longer term outlook for a recession is consumer spending. And consumer spending right now remains strong. Consumer spending is represented here by the purple line, and private employment is the pink line, and they're often closely linked in an economic sense. So with consumer spending remaining steady, there's less concern about the severity of a recession. We're still getting a lot of questions from clients about inflation, and we talked last month about how you as an investor and a consumer will feel the effects of a recession and of inflation faster and earlier than when the recession is actually called. So hang in there. The biggest driver of inflation right now is the effects of the stimulus that we've seen the past 2 years and also a surplus of goods and inventory. And so there's signs that inflation may be peaking. We expect it to remain above the 7 to 8% mark through the end of this year. More on that here in just a moment. But in general, I want you to keep your seatbelts fastened as we head into the fall. We are almost certain to see more volatility for the rest of the year. The sell-offs and the general portfolio rebalancing that many fund managers did earlier this year, they're all continuing to affect market movement, as well as ongoing aftershocks from the last few years of turmoil. As you'll see in this chart, which features the S&P 500, the market has a ways to go still in order to fully rebound. But history teaches us that the probability that that the bottom has been established in the market is probably pretty high. But it also teaches us that there's a high probability we may retest the lows we've seen earlier this year before the market fully recovers. Now, this is not a prediction. We just study market history, especially bear market declines, to look at what history tells us. So it's very common to see huge rebounds like we've seen since June in the middle of a bear market. We in the industry refer to this as a bear market rally. But it's also very common to see markets retrace those gains before it moves higher. A big concern going forward is GDP, gross domestic product. I mentioned this term earlier. In layman's terms, GDP is an estimate of how big our economy is or how quickly or slowly it's growing or slowing. So in the second quarter, GDP expanded by 1.6% over the same quarter a year ago. The Fed watches this closely, and so do we. And I'm expecting GDP to continue falling for the rest of this year. And this brings us to the US dollar. The dollar is really, really strong right now. As you can see in this chart, since June of 2021, we've seen the dollar rise significantly. And this is generally a sign of fear and something that we are continuing to watch closely. Another worsening data point that was revealed in July is 4 out of 10 adults, as reported by Bloomberg, are having difficulty covering their household expenses thanks to rising prices. So the consumer is not in great shape right now. When AT&T comes out and says that people are having trouble paying their cell phone bills, you know that the pain is real. And people are also tapping credit cards like crazy right now. That's not a good sign when you think about the fact that credit card interest rates are also rising. Here's more big news from the end of July that may affect our fall months and even potentially our new year. I'm sure you've heard that the Fed raised interest rates by 0.75% at their most recent meeting, and this is what we expected. But what's changed is that Federal Chair Jerome Powell stated that he doesn't believe the U.S. is fully in a recession yet, but he has acknowledged that the economy is showing weakness. So ultimately, we have to pay attention to the Fed. Many of you may remember me quoting an old saying in the months following the Fed's massive stimulus during 2020. You can't fight the Fed. That means if the Fed is stimulating the economy or adding liquidity to the system like they were doing back then, it generally means good things are to come. But the reverse can also be true. When the Fed is tightening by raising interest rates or sucking liquidity out of the system, it can be challenging for markets and for investors. So since you can't fight the Fed, that means we can be pretty sure that there's more turbulence to come. Also, pay more attention to what the Fed actually does than what they say about the economy. Actions speak louder than words. That leads us to the latest edition of what we are watching this month. And this month, it's all about the last point I made. The Fed's actions for the remainder of 2022 is probably the single biggest driver of what the economy will look like as we head into 2023. If the Fed starts to lower rates, that's a sign that the economy is slowing and one that may be concerning for consumers. So their actions will likely set the stage for economic growth or even stagnation going forward. At EverThrive, we hope you know that we're always actively managing our clients' portfolios and their investments, and we're making any necessary adjustments within their risk tolerance levels. We always try to have a plan for rising market conditions, but also falling market conditions. And so regardless of what the Fed does or doesn't do, we try to be prepared. So if you have money in an employer-sponsored retirement plan, be sure to check the amount of risk that you're currently taking and measure it against the amount of risk you're comfortable taking. It's always best to avoid making emotional decisions in the middle of market ups and downs. So we continue to encourage you to contact us if you feel nervous about your money or even your financial future. On that note, thank you for joining us for this market update. Stay well, and we will see you again next month.